Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn.
Chicago wheat. Well, this past week has been one of two things. Either it was some of the most stunningly accurate technical analysis I have done in a while, or else someone was taking the mickey. I'll explain shortly what I mean, but first let's take a look at this market's overall picture. The bear channel, currently at 540 to 614 for the February to June action, which is highlighted on my daily chart in bright red, have been the most significant pattern this year. 2 weeks ago, the market broke up through the upper bear channel line and confirmed the break higher by the end of that week. It did this by not only closing over the short medium moving average, currently 656, but also above the 50% absolute Fibonacci line at 682 and a slowly dipping medium moving average, currently 683. The move up over the 50% absolute Fibonacci line was intrinsically important, but it also was important in another sense, as it was the gateway to the congestion band from March and April between 682 to 721, within which are the January 2021 high at 693 and the old October 2013 high at 721. Last week prices followed on even higher by utilizing the medium moving average as a base for an attempt up into another congestion band dating from December last year through to February this year. Between about the March 2014 high at 725 up to the lesser Fibonacci line at 799 and containing the January 2022 low at 739 and the May 2014 high at 744. The market made it up into this congestion band, pushing up as far as over the March 2014 high and even over the one piece of resistance that was coming down that it could not easily overcome, and that's the slowly declining long moving average, currently 749. This held on a closing basis. Okay, so this is where I discuss whether I have named a specific level as one of the most stunningly accurate pieces of technical analysis I've done in a while, or else someone was taking the mickey. You see, for a few weeks now I've been talking here about the bear channel highlighted in bright red that I mentioned earlier. Last week I even finessed the point further by specifically highlighting a topside level that was what I said, and I quote, "Thus a primary target X would be in the 770 area, only a little above where we have reached, but the secondary target X1 will be a lot higher up in the 855 area, and there's quite a lot of some congestion, there's quite some congestion overhead, and one important downtrend, the March 2022 to date downtrend, that's currently 837. This is the one based on the ultimate high of this market, but we'll have to see if the market can achieve target X first." End of quote. Well, as you can see, the high last Monday after my latest commentary was in the 770 area, specifically at 770 and a quarter. This happened and then the market turned and fell away. I do not believe that to have been a coincidence. I suspect it was another technical analyst who also came to the same conclusions I did and acted upon them, or it could have just been the market taking the mickey. In whichever case, I'm grateful to see target X achieved and then to see all the prices fall away, justifying it. Now, last week and the week before, I also started a discussion on my idea for the construction of a possible new large pattern. It's a February to date and possibly even October 2022 to date descending scallop pattern. This one has been moving along quite rapidly from its infancy. I earlier gave some ideas for this pattern. I quote, "The first level to watch and see if it develops is right around where we are, the 708 area. The second, that would be higher, around the mid-780s. More on this should it develop. I just wanted to give you a heads up just in case." End of quote. Well, the 708 level did nothing. However, the 780 area, well, that exhibited potential last week and this, and it would also be for the potentially larger October 2022 to date action. Personally, I suspect if we haven't had the declining long moving average capping the market, this would have been a lot harder to see. That being said, we are close, but we still have some building to take place to form this pattern. And so many things can scupper this idea before it happens. So what should we look for? in case it does become a descending scallop pattern? Well, the market needed to hesitate to form a lip, if you will, which it did do late last week and at the start of this week. After this hesitation and lip building, prices needed to move in the direction of the ultimate pattern. Now, this move could have been both up and down, but in this case we have seen it has been down, and it's important to note that a little over 3 out of 4 times the subsequent move is actually down for this pattern. That is what we've started to see this week, with prices dropping down through the previously named resistances that became supports and are now turning back into resistances once again. What is now needed to see the fulfillment of such a pattern construction, and please bear in mind, this is just the completion of the construction pattern, not its outcome. So what is now needed is to see that if prices can come down to the base of the scallop. And for this I would suggest the July 2021 low at 609, and to then see if the next move would be lower still, because then, and only then, can we possibly start laying some potential targets further down. Chicago corn. 2 weeks ago we saw a market's recovery that was truly remarkable, and it carried on into the first part of last week. Prices punched up through the older congestion at 548 to 556 and at 561 to 567, like they were not even there, along with more recent congestion from early May between 580 to 600. This congestion, as I said 2 weeks ago, and I quote, apart from being recent, it is also not that strong, and it would not be surprising to see a move higher towards a wider band of stratified congestion from February through to April between 610 and 640. End of quote. Now I continued, and I quote, beyond that comes the first big significant longer term resistance, the 50% Fibonacci line of the September to May 2023 move at 655. In between any attempt there and where we are now, I hope we can see a new pattern emerge, perhaps a skeletal descending scallop pattern. But it's too early to see right now. Additionally, to the congestions, the market also punched up through the short medium moving average, currently at 563, the medium moving average, currently 597, as well as the late February to date downtrend, currently 603. All these, along with the 610 to 640 band, have slowed and eventually turned the market back down without the need of relying on the descending long moving average further up, which is currently at 635. To cap prices, that was what it was doing up there. Now, the pullback lower late last week and into this week has been similarly remarkable. The one key piece of action I wanted to see, I described last week thus, and I quote, to see if we're forming a lip as part of the descending scallop pattern. And by lip, I mean the following. In case the market chooses to try and form a descending scallop, and it would first need to hesitate to form a lip, if you will. And then after hesitating for a moment, move in the direction of the ultimate pattern. Now this move can be both up and down, but it's important to note that with a little over 3 out of 4 times, the subsequent move would be lower. That is what is needed, or that is what is needed to be seen in case this market does intend to form a descending scallop pattern. I have to say, if it does try to do this, then it will be one ugly looking pattern, end of quote. Okay, so we have seen the market hesitate and fall, in the process forming a lip. The question now is, how far will this market need to fall to fully construct the ugly looking descending scallop pattern that will be here? At the moment, the market is being held up by the combination of the 2014 high and the 61.8% absolute Fibonacci line at 525. This is not enough, nor is the October 2021 low at 516, nor the lesser Fibonacci line at 506. Only when we can see prices down within the congestion between 486 to 498 that contains the 2021 low at 498, only then can we start looking at this potential descending scallop as having been formed, and thereafter at potential targets below.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.